So I'm going to be explaining incremental analysis, which is also known as differential analysis. And it's basically just a method of making decisions that's frequently used in business. So to start out, you have to outline the basic decision-making framework, which first, you're going to identify the problem. Secondly, you're going to determine and evaluate your alternatives. And that's really what's focused on with incremental analysis, because essentially you're comparing different alternatives and analyzing them based on the financial costs involved. And you can do that through various different factors, but usually it's going to come down to how the different alternatives affect your net income or your profit. The third step in the decision-making process is to actually make your decision, which is aided by your evaluation. And then after the fact, you're going to review that decision and you can compare it to the analysis, see if your predictions lined up with what actually happened, and decide if it was a good fit for your company. So first of all, when you're doing incremental analysis, you have to consider a few different types of costs. Incremental analysis is only concerned with financial costs, although there are going to be non-financial costs that will factor into real-life decisions, such as employee happiness and satisfaction, the environment, public view of your company. But for incremental analysis, you're going to be focusing on relevant costs, which is the most important, opportunity costs, and sunk costs. So relevant costs are obviously, as indicated, relevant to your decisions and are going to help determine how these choices affect your net income, various things like that. Opportunity cost is what you're giving up to make a decision. So an easy to understand example is if you're a student, time that you're spending sitting in the classroom is time that you could be out working. So the opportunity cost of being a student is the money that you could make on the job, or maybe even the experience that you could gain on the job. And sunk costs for the purposes of incremental analysis is going to be the historical cost of your item, so basically what you paid for it when you purchased it, minus the accumulated depreciation that you're going to be keeping track of in your accounts. And sunk costs you never really want to consider when you're making a decision, because that's money that's already gone. So you don't consider that when you're making your decision, because you're not going to get it back no matter what decision you make. So there's 5 major types of decisions that incremental analysis is used for in business. The first one is whether or not you should make a special order. So say you're a company and you make a product that normally you charge $30 for, and someone wants to place an order and only pay $25. So you can compare the cost that you're going to incur for making the product and then the profit that you would make. And generally, if you're not at capacity at your factory or manufacturing facility, you're going to compare if you would make more money from selling the product than you would incur in variable costs. And if that's going to be the case, then you would choose to make the special order, because fixed costs are not going to change if your facility is not at capacity. You're still going to have to pay rent and machine costs and things like that, regardless of whether you make it for a slightly cheaper price. Another decision that is really helped by incremental analysis is the decision whether you want to make your own parts or buy them. And for that decision, you would have to add up all of your costs for producing the parts, such as labor, materials, and manufacturing overhead, and then compare that to how much it would cost you to just purchase the items. And if you are going to come out where it's cheaper to purchase the items, then you would do that. If it comes out where you could make them for cheaper yourself, even with labor and materials costs, then you would choose to make your own. Another somewhat similar situation that incremental analysis is used for is whether to sell an item at a certain stage or continue processing it further. So you could decide between if you wanted to sell an unfinished table or if you wanted to continue on in the process and sand it down and stain it. And again, you would be comparing what costs you would incur in materials and labor and in overhead, and determining if you would be able to recoup those costs by selling a finished product at maybe a higher price. So with selling or processing further, the big thing to consider is if the revenue that you're going to be getting from selling the finished product is going to be more than the cost you're incurring to get it to that finished stage. So if you're selling a product that's partially done and you're making $50 on it, and then you're selling a product that's completely done and you're making $60, you have to decide if that $10 of extra profit is going to be cheaper or more expensive than the cost that you're incurring to get to that finished stage. Another type of decision aided by incremental analysis is whether to repair or replace equipment. So you would compare the costs of repairing your existing equipment versus the cost of buying entirely new equipment. Or if you really can't afford anything, then you could even consider, we don't have enough money, and we would compare just keeping the current equipment in its current state. And you would consider increased maybe production capabilities, the cost of the actual equipment, the salvage value of the equipment that you currently have, and perhaps even the salvage value of the new equipment in a period down the road when you're making that decision. And the fifth decision that is frequently used with incremental analysis is whether or not to eliminate a segment of your company that's not making as much as you would like to, or is just unprofitable. So for that, you have to take into account the money being brought in by that segment, as well as the costs that you are incurring to keep it open. But you have to consider, if you have a company with multiple divisions and multiple segments, that you can't just eliminate something because it's not making money. You have to take into account the fact that any fixed costs are going to have to be absorbed by other sectors. And that's a big factor, because a lot of the time the fixed costs are going to be more than what you would be eliminating as far as the unprofitable segment. So if you're going to eliminate that segment, you have to make sure that the fixed costs that are going to be eliminated, not just redistributed into a different segment, are greater than the contribution margin to your net profit that you would be losing by eliminating the segment. So that's incremental analysis. It's basically just going through, listing the costs of your various options and comparing them to the profits that are to be gained by those options, and deciding on which measurement is most important to you, and then making your decision based on which of the options meets those criteria.